first question I'm always asked is, what does private equity actually do? We read about it constantly, but it's always about the deal or some controversy. And in fact, private equity's got a very clearly defined way of creating value for the investors within the private equity space. First and foremost, of course, the team has to raise a fund. And we call that fundraising, unsurprisingly. And the team might spend quite a bit of time getting a fund together from the investors, which, by the way, probably includes every single Australian watching this video, and creates a fund with a specific strategy for the kind of businesses they're going to invest in. And that fund might decide that it's going to invest in very large-scale businesses or small-scale businesses. It might be a minority investor. It might be a longer-term investor. But whatever it is, they've got a very clearly defined strategic objective for their investors when they're running the private equity fund. So they do their fundraising. And over the last 25 years that I've been involved in Australia, 37 billion Australian dollars has been raised by the private equity space. And that's been invested in hundreds of companies over that 25 years. You might be interested to know that every week, roughly 2 private equity investments are made. And you never hear about those. You only hear about the giant investments which make the front pages of the newspapers or even the TV news. So the private equity firm, having raised its fund, then makes its investments. And those investments are made over a 4 or 5 year period, which we call the investment cycle. How does the private equity firm then add value to those investments? And the old mythology is that they simply cut costs and sell off the assets and they make their profits, which is total nonsense in today's world. The private equity firm focuses on a multiple different ways of adding value to its investment. And they hold those investments for 3 years or 4 years or 5 years or 6 years, working diligently with the management team to make sure that the company becomes bigger and better, more sophisticated, and worth more money. And that's called value add. There comes a time, of course, where the private equity fund has to sell the investment to return the profits to the investors. And that's called exit. And a lot of work goes into planning how to exit the investment even before the investment is made. And a lot of work goes into working with the investment banks and corporate advisors to make sure that that exit is a successful one. So if I just recap, what does a private equity firm do? 1, it raises a fund. 2, it invests that money into companies. 3, it works with the management team as well as they possibly can to create value. And 4, after a period of 3 years or 4 years or 5 years or sometimes 6 or 7 years, the investment is sold through primarily 3 different mechanics. Either an initial public offering or a trade sale or a secondary to another private equity fund. And why does the private equity fund do all of this? Well, the answer must be obvious. It's to return to the investors the profit on the investment. In Australia, most of those investors are superannuation funds. So it's incredibly important that the private equity fund makes a profit on those investments to return back to the people who have invested their superannuation money into private equity. So that is what a private equity fund actually does. In my Essentials of Private Equity program, you'll learn a great deal more detail about every single one of those 4 vital elements of private equity.